Hey traders, let's see if I can shed some light on when I say I own protection for the market, for the stocks. I'm not betting against the market, but if I have assets in the market, if I have longs, if I own stock, if I own calls, if I am short put spreads to where I have thousands of dollars at risk, the bigger, obviously, the more important to protect. I don't use protection in the market every day, but we have to admit that we're going into a let's see, an uncertain period of time through next week, the U.S. elections and whatever comes from it, COVID, reemergence. The rhetoric in the media is terrible. I'm not worried about the companies. I can't imagine a scenario where Google's earnings, for example, are going to be cut in half. Facebook, we might have zombies in the street for that scenario. So then the worries will be something completely different. But in the quote normal operating procedure, you can buy protection just for a period of time. Options is the easy way to do it. If I own stocks, I would sell covered calls against them, and I'll show you how to do that in a little bit. So this is going to be, I'm going to start with the easy and then get into the weeds. So the easy part is to buy downside bets on the market. So let's see here. We're looking at the S&P. Let's look at the SPY for simplicity. A lot of people look at the SPY. They don't. It's not so easy to get the concept of the futures contract. So this is the S&P, the SPY. It's the ETF. The SPX is the index. This is the ETF. Okay, so the ETF pings off of the index and it mirrors it. Whatever happens to the S&P, SPX will happen to the SPY. It's 10 times smaller. So you can see we're off the highs, but this is all-time high. So we can be down here and it would change nothing. This is the COVID low. It didn't change anything, right? We fell into hell and we climbed out of it. If we fall into hell again, we will climb out of it. So keep that mentality. If we lose this level, then there's something fundamentally wrong with the world. Like here, we shut down everything on the planet. Nobody was making money and not a company was operating. That's the scenario. What other scenario could it be for us to lose this one? World war? I mean, what could be worse than shutting down all businesses for a business chart? Nothing. So I would consider this a bottom. And if this is lost, then we have other problems and you won't be listening to this video. So what about now? Where do I buy the protection? When do I buy the protection? For how much? It all depends on what I'm long. If I'm long all kinds of stocks, I would use the SPY. If I'm long nothing but tech, I would use the QQQ, which is another ETF, but for the NASDAQ. And it looks similar. I'll take the lines off in a little bit. Do I short everything because I think markets are going to fall? I wouldn't do that. You can do it as a trade, but I wouldn't, mortgage the house and do that because they can go up or down. We don't know. I knew the outcome of the elections in 2016. I was confident of my guess. I had no idea they were going to rally. I was short and I lost money. So it's like earnings. We don't know the outcome, and we don't know how people are going to react to the outcome. It's like a double coin flip. How can you make money off of that? You're just gambling. So I'm talking about protecting an asset. If you have 100,000 invested in the stock market, wouldn't it be worth a little bit to protect it? If you own a car that's worth 30,000, you're probably paying 300 a month to protect it. If you own a house, you're paying thousands a year to protect it. You're paying thousands a year to protect your health with health insurance. How is this different? It's an asset, just like a house, just like a car. Your health is not an asset. It's probably your best asset if you want to put money to that. So this is the same concept. And the protection doesn't have to be garbage. So the way I make it not garbage is I figure out how much I want to protect, and I figure out the depth. Okay, so what if the S&P falls from here to here? And how much is that? 20%. Okay, that should be a pretty bad scenario. What if everything fell 20%? So I want to protect basically a drop of 20%, my assets against a drop of 20%. If my stocks are green and the drop of 20% will get me back to even, I probably wouldn't worry about it much, because the story is not going to change. I will protect it a little bit. But if I'm already in the weeds, underwater, if I'm already buried, if I bought up here and now I'm buried 20%, I want to protect it. So I'd stop the bleeding, kind of a deal. So this is the case. This is the logic. So how can I actually do it? I'm going to show you how. So the SPY, this is the S&P, this is a practice account. This is a chain, options chain. Puts is what we're looking at. This side is all puts. See put right there. So this is for November. I can use November. Probably easier to use December. The further out I go, the more expensive the protection, but it has life. So in the next few days, if nothing happens, next few weeks, if nothing happens, then these values will die quicker than this one. But they are cheaper to buy. So this is where all the action is supposed to be in these 3 weeks, these 3 expirations. So this is 1 week. You can pick a week you want, but the concept is the same. It looks like a whole bunch of people picked this one. There's 121,000 contracts right here. So times $12 each times 100, that's a lot of money. So that's a point of interest for people. Maybe it should be for me. So let me see it on the chart. Right there. This is a natural support zone. I don't want to protect that scenario, that's personally, but here's the argument for doing that. So what happens? So if I buy this, it costs $1,200 for one contract. That's a lot of money. Okay, so if I have a lot of money at stake, that's probably what I'll do. So how can I make money? If price falls through it, look, it gets expensive. So let's say price drops 20 bucks. So it'll be the equivalent of looking at something that's already $20. So $3.48 would be the equivalent. Let me go see how much it is. It's 26. So I would have made $14, so $1,400 just from one contract. Okay. So just one contract would, but that's pretty expensive for people. And if price moves up, this $1,200 will drop quickly. $1,300 would drop quickly. So how can I moderate my protection? I do a spread. I buy something and I sell something. So if I want to buy the 320, I'll sell the 310 maybe. Let's see. So now we're talking $300 per contract. So how's that bad? I'm going to go lower to show you. How is this worse? Oh, sorry about that. There we go. How is this worse than the other one? Worse is I have limited protection, meaning if it goes to 0, I can only make X amount. What's this X? So I'm going to go to one contract to show as an example. So I'm paying $3.20, $3.10 per contract. I can only make $700 per one contract. Why? Because I'm long here. This my protection starts right here at 320. 320. So if price falls through, I'm making money. This goes to 13, 14, 15, 16, 17. See, it goes up. But I'm stopping my winnings right here at 310. So the maximum I win is $10. 310, 320. But I paid 3 to get into it, so my net profit is only 7. That's pretty good. So if I have a lot of money and I do 10 of these, I spend $3,000, I can guarantee $7,000. So if I'm trying to protect $100,000, now I have a tangible amount that I can say, okay, it stops the bleeding, you know. So then I can react like yesterday. So if I wake up and the market is down $20, then I can react almost like yesterday because I have greens. I just made $7,000 on this dip. I lost on the other stuff. They washed themselves out, and then I can decide on cool head, what can I do today? This is with 10. If I did 10 contracts. And the trade should be, it's a debit, it's an expense. If I did 10, I'm going to go back to 1 so I don't entice anybody with amounts. The amount's different for everybody. So 300 net, I spend 300 plus commissions. And if I hit send, it should fill. And this is a practice account, so let's do it. Let me see here. They probably won't fill it at first try. Nope, but it's filled. Okay, so now it's an asset. You see my position is right there. Now I'm protected to the tune of $700. I have a small account. I'm protecting not a lot of money. I want to make $700 on a bad day. If nothing happens, I may lose $300. I just paid $300 for this bet. So what happens tomorrow? If, let's say this is the week, I have 49 days on this trade. Let's say 2 weeks from next week, somewhere in the middle of the week, markets are neither here nor there, up a little bit, down a little bit. I go and close it. If I decide that there's no longer a threat, I can sell back the insurance. You can't do that in real insurance. There's my position right here. It shows I paid $3.09 for it. It's now worth $313, $307. It's gyrating. The stock market is moving right now. Yeah, I see some green ticks. So it moves. See, price moves. There are two legs in there. A put that I bought and a put that I sold. I win if price goes down. If price goes down, I make money. And this is to offset other longs I have. So this is the case where if I decide to close it, let's say I change my mind. Next week, I feel better about things. I know who's going to win. I'm comfortable with what's going to happen thereafter. I'll say close. And then I'll close it, and I'll either get more or less than $3. Even if I got 200, even if it's only $2 worth next week, I lost $100. I mean, how much do you lose a month on car insurance because you don't wreck your car? Is that a sad situation? It's not. You're happy you didn't wreck your car. So you wasted $150 on the insurance. Big deal. That's the point. It let you drive the car. It let me stay in the market. So that's the concept of buying insurance, and it's almost like renting insurance. And sometimes, and if the market rallies 10% in one day, this $300 may turn into 50 cents, $50. So be it. I didn't wreck. I'm happy. Everything else is green. That's the point of insurance. People are crippled when they think about spending $500 to protect their portfolio. Pick a long period of time, long enough. I didn't pick next year. This bet will be pretty expensive the longer I go out if it's lower. There's another way to do it if I pick it closer to current price. Like if I want, like this is at 320. We're at 328. What if I wanted to protect it closer to current price? I could have done that. What if I wanted to protect it closer in time? I could have picked November. It's cheaper. Maybe not with the VIX this high. Let's test this concept. So why would I go to November? A, the protection, it pays quicker. So if a price a little bit cheaper, 40 cents cheaper. So if price falls to zero, this one gains a lot faster than the other one. So this one will pay me my $700, $750 in this case, because I'm paying less for it. Okay, so I can move this whole bet up to say I don't want to lose anything. So now I'm paying $3.30. I like this better because now I don't have to guess how far the market needs to fall. If it falls a little bit, I'm already making money, protecting myself. So that's the way to do it. And if I have no positions and I want to short the markets, that's how I can short the markets. I buy one of these, and if the markets fall, I make money. If not, I lost $300. So per contract, one contract. Okay, so this is how an easy way to protect. All right, that's the first part. And this can be done on the SPX, SPY, QQQ, DIA, whatever ticker you want. Apple, if you own just Apple and you can do this for Apple, you say, okay, I want to protect myself in Apple. I don't want to go below 100, so you buy a $100 put for $141. It protects 100 of your shares for 21 days. If Apple goes to zero, you're guaranteed to be out at 100. Guaranteed. It's not if, ands, or buts. In fact, you can call anybody, say, hey, I want you to buy Apple at 100 at any point in time. Why would you do it now? I don't know. But if it falls below 100, you are guaranteed to call, come pick up my shares at 100, you promised. They will. They got paid $141 to guarantee your 100 shares. Okay? And this for 21 days. If you just want to do it for next week, you just go here. It's 60 cents to do at 101. But, depends on what you own. That's one way. Here's another way. So let's say I own Facebook and I'm worried about Facebook and I want to protect myself somehow. I don't want to buy anything and I don't mind getting out of Facebook at a certain level. Then I can sell calls. They're called covered calls. What are these? Don't get pissed at me if you get sold out of your stock. But here's the concept. If I own shares, I would do this all day, every day, all year long, every year. It's a way to create income. So put my asset to work. Current price is 265. Let's say I bought Facebook at wherever, 200. So I'm green. If I'm forced to sell my stock at 300, is that a bad thing? No. So I say, okay, if Facebook goes above 300, I promise I would sell you my shares at 300, even if it's at 305. So for that, you get paid money. So I picked 300 randomly. So let's look at the chart instead of speculating. Facebook. All right, so looking at the chart, the all-time high was 300 and change, 305. By the way, they delivered pretty strong report. If I'm long, I would stay long. I would buy the dips. There is a head and shoulder. There are some scenarios here, but all of this area is buy the dip, buy the dip, buy the dip. It's good support. If it breaks out of here, it's going to go to the moon. Let's say I'm okay selling my shares at 340. I mean, it sounds reasonable, right? 340. Mind you, it's 265 now. Okay, so let's see if there's any premium at 340. 340 right here. I go across 100. So if I own 100 shares, I can collect $100 today. If I'm okay selling them at 320, I can collect $250 today. What would that mean? It means I would sell this as a covered call. If I own shares, if I own 1,000 shares of Facebook, I can collect $2,500 today. If I own 100 shares of Facebook, I can collect $260 today. What am I giving up for doing that? Why am I getting paid? I'm guaranteeing somebody an entry point at that price. So I own 100 shares, and I'm saying that somebody out there, somebody is paying me. I don't need to know them. I sell it, and they say, I say, if Facebook is at 320, call me. I will sell you my shares at 320. Meanwhile, pay me this premium to lock your price. Okay, it's like a down payment. It's not like a layaway. So they can call and say, I want to buy it at 320 at any time. So I don't know why they would do that at 300, but they have the right to do that. But if it's above 320, you're forced to do that if they call and you promised. It's not a big deal because you got in at lower, right? So that's the point. It's like creating dividends. If the stock doesn't pay a dividend, that's how you create dividends. Let's say you want it to be shorter in time and lower. You can do that. You can do that for November, and you can do that every month, every week, if you can pick a level where you're okay to sell it. Or you can go out in time and you say, you know what, between now and next February, if it gets to 350, you can make $500 at 340. But now, it has earnings reports between now and then. It has the election relief rally from that, etc., etc. So this is one way. How is this protection? Well, that buys you $5 of downside. Let's say you sell this and Facebook falls $20, $30. $5 of it is offset because you just collected $5, right? So these are ways to protect. Again, protection, we shouldn't protect everything all the time. It would get pretty expensive. But having balance in a book is good. I'm always short something, not stocks. If I'm long a whole bunch of stocks, I'm always selling call spreads in the SPX and the SPY, something out in time that if we have a collapse, then I'm making money. And if we rally, I might lose some money on the protection, but that's the job it does. All right, so hopefully these 20 minutes, 18, 15 minutes, whatever it turns out to be, are helpful. These are the ways I think of how I can protect the portfolio. Of course, getting out into cash is always a position. Then you're protected 100%, except against the collapse of a government, which is highly unlikely. But just hoping for the best, it's a coin flip for a short period of time. My feelings about the market. We're pretty high. I mean, this is all-time high. The sentiment, here's a tool I use. Sentiment was 8, and that was too high up here. It goes between 1 and 10. 1 is extreme hate, 10 is extreme love. I don't think it ever goes to either of those two. So 8 is as high as it goes, really should go. Yeah, it doesn't go to 10. And it goes to 1 maybe once in a blue moon, like the bottom of the correction. It should be between 4 and 6 according to the people that make this tool. So now we are closer to 4, way below 8. I feel better about sentiment. The lower the sentiment, the better the odds of a rally. So it wouldn't stand in the way of the rally. And I just heard a beep. Let's see what that is. Palantir, buy it. Oh. It's falling into support. Yeah, I'm not buying it. So, all right, Nick signing out.